So let's start with this. Does a reduction in the federal funds rate, does that push mortgage rates down?
The best word I'm going to give you is possibly indirectly. So I'll give you 2 words.
Okay, but that's really now we're going to describe it a little bit more.
Okay.
But that's really a pretty good description. So the Fed funds rate is the interest rate that the Federal Reserve has charged between banks who loan money to one another. So it's a rate. One bank loans money to another bank for a day, overnight, for a certain period of time, and that's the Fed funds rate. And Tammy is so right to say, well, possibly and indirectly. I would say over time, it doesn't directly, but if they go down, mortgage rates go down. But it's not why you think it is. So I was talking to somebody the other day, and they said, well, the mortgage interest rates are determined by the yield on the 10-year Treasury bond. And for years and years, there was about a 1.5% to 2% spread. So if the yield on a 10-year Treasury bond was 3, then mortgage rates might be 5, 1.5%, 2% higher. It actually got a little bit out of control. But this time, mortgage rates went down from probably 6.7 to 6.2 or somewhere right around 6%, and they hadn't been that low in a long time.
Yeah.
When I bought my house in the last year, mortgage rates were at par with like 7.25. So it's a big, big difference. But mortgage rates, again, federal funds rate goes down, and then mortgage rates go down.
The mortgage rate's been going down before they dropped the Fed funds rate.
So that's exactly right. So the mortgage rates were forced down because the market expected there to be a rate cut. Now, they only expected a rate cut to be 1/4 point, and it was a 1/2 point. So I think mortgage rates will continue to go down. It's so interesting. You could look at the yield on the 10-year Treasury bond today and predict whether or not mortgage interest rates were going to go up tomorrow. The majority of the people I talk to think that all the buyers who are on the sidelines are going to jump into the game and start buying properties immediately.
I don't.
So tell me what you think happens when interest rates go down for borrowers and buyers. What do you think happens first?
First, there's a pause.
When you say pause, what do you mean by that? You mean buyers, they know
there's more.
Got it.
There's more.
So they're like, oh, you have my attention, sir. You have my attention, but let me wait and see what happens for the next 2 months.
Right. They go, okay, we're starting to go down. So they start warming up, but there's the pause. And those that were looking, ready to make the offer, ready, that rate drops, and they go, oh,
yeah, maybe
is it going to drop a little bit more? Is it going to, because they all want something more. And it's human nature, right? Like I'm teasing you. Oh, but there might be a little bit more behind door number 2.
So, but it's like people trying to time the stock market. Like you don't really know what's going to happen. And I think, honestly, for someone who really wants to buy a house and they've been thinking about it for a year or 2 and working on it or dedicated to it, I think you need to be real careful because you could wind up waiting and ultimately get a higher interest rate.
And that's when they'll come out. The moment it swings, the moment
it starts to go back up.
Starts going back up.
That's true. You get a lot of people on the market.
They will all jump out.
Yeah.
But the initial down causes just a small moment, but it causes a pause. Just for a moment, it causes a pause because everybody thinks, is there more?
Yeah. And so for those real estate agents who are listening, you might see things a little slower before they pick up. For home buyers, you might see interest rates continue to go down, but I would be careful because if they do continue to go down, then people are going to jump in, they are going to buy. And it could be that the home you want to buy,
it's going to go up in price.
or even worse, gets bought by somebody else.
Absolutely.
And then you can't live there. And for home sellers, I would say if you're thinking, okay, interest rates are going back down, now I'm back on top, now I'm the king. In Atlanta, it's not really a fully balanced market. It leans a little bit more to sellers than it does to buyers, which I think is probably the same way in Dallas.
It's
who knows?
leaning towards buyers.
It is? So you have
we're
almost 5 months worth of inventory?
Well, we're so some of our counties we're sitting at 7 or 8 months of inventory.
Dang, those are probably further out.
They're a little bit further out, but the county I'm in, we're at just over 4. But when I say we're leaning towards buyers, because when you're used to hearing and experiencing and seeing the 2-week market, 2 months inventory feels like a buyer's market. You talk to one seller who's been sitting on the market for 6 weeks.
Yeah, when everything else in the world is selling in 20 days.
Right.
Yeah, that's a good point. So sellers, still be open, still be flexible.
Yeah.
You can get a good price. Buyers, get on out there.